for next generation data and analytics and cloud infrastructure solutions. News is an integral part of financial markets, and we are extremely proud to be the exclusive provider of Reuters News to financial professionals. And we deliver that news via, one, LSEG Workspace, our flagship workflow tool available via desktop and mobile. Two, news feeds, where we transform high volumes of news into machine-readable formats. Three, portals and redistribution that let you tailor your feed to drive optimum insight. Today, we're privileged to host this prestigious event at our office in partnership with Reuters, and I'm excited to listen to two interviews taking place this afternoon. Firstly, we'll be hearing from Piyush Gupta, CEO of DBS Group. Then, after a short break, we'll have a second interview with Jacqueline Poh, Managing Director of the Economic Development Board. Really excited to hear their insights into their plans for Singapore and growth in the region. With that, it's a pleasure to hand over to So-Young Kim, editor for North Asia, Southeast Asia, and Australasia at Reuters, to share more about what we can expect from today's exciting discussions.
Thank you very much, David, and hello, everyone. Welcome to the Reuters Newsmaker, and thank you again for joining us today. I am So-Young Kim, Reuters News Editor for the Asia-Pacific region. Today, we are hosting our first in-person Newsmaker event in Asia post-pandemic, and we are really pleased to do so here in Singapore. Singapore has long been an Asian financial hub, and its resilient, trade-reliant economy is seen as a bellwether for Asia's growth. But its stature really grew during the pandemic as people saw how the city-state managed it through the crisis, and people and investments are flowing into the country. So it was a natural destination for us as we gear to resume in-person events. And next year, we hope to do more such events across Asia. As the world's largest multimedia news provider, Reuters has the biggest presence in Asia among international news agencies. This presence reflects our commitment to provide first-class coverage of Asia. With a deep pool of local and foreign correspondents based in the region, we aim to offer the deepest insights about what's going on inside the region. And we marry this in-depth reporting from the field and local expertise with our globality. Every day, Reuters journalists, more than 2,500 Reuters journalists around the world in 200 locations deliver unmatched coverage in 15 languages from every corner of the world with accuracy, speed, and balance. More than anything, what sets Reuters apart is our trust principles: accuracy, independence, integrity, and freedom from bias. In this era of misinformation, false claims, and artificial intelligence, the need for impartial and fact-based stories has never been greater. The provision of fast and reliable news, especially in financials and equities, is hugely important to our partner LSEG and its customers. In the past year, we have made significant investments in Reuters financials and markets coverage, adding more than 100 new editorial positions across Reuters newsroom globally. This includes a significant expansion of our equities coverage across both India and China. Today's event here in Singapore is the second part of our Global Wealth Investment Week, following on an earlier interview, Reuters Newsmaker interview with Julius Baer CEO, Philip Rickenbacker on Tuesday in Zurich. Those interviews may have been on opposite sides of the world, but many of the challenges and opportunities, they are the same. On that note, I'd like to give the floor to my colleague from Reuters Breaking Views, Anshuman Daga, to host a conversation with DBS Group CEO, Piyush Gupta. Please welcome them both to the stage. Thank you.
Okay, everyone, thanks. Hi, Piyush. A very warm welcome to this Newsmaker event. As Soyan said, it's the first time we had it in 5 years, so it's a pleasure. I know it's a packed schedule for you in the F1 week, so we're really happy that you could spend the afternoon with us. And thanks also to the audience in the room and for those who are watching us online. So Piyush, I'll start off with the wealth management sector, something that obviously is the cornerstone of DBS's growth strategy. It's exactly 3 months since we have seen UBS complete the shock takeover of Credit Suisse, an enormous event in the wealth management industry. What do you think has been the lasting impact of this, and how does it look like from Asia?
It's not clear to me that there is a large-scale lasting impact in the sense of theory or trend. People have been saying this is a precursor to a lot of consolidation in the sector. And I frankly don't understand why that would be the case. You normally see consolidation in sectors which are slowing down or sunset sectors, right? So you need to consolidate to get some kind of advantage or synergy. We are putting things together. Wealth management is the fastest growing part of the financial services landscape. Growth is great and returns are great and continue to be very good. And therefore, as a matter of fact, what you're seeing and will continue to see is more and more participants in this space. If anything, I think wealth management is going to expand its horizons from ultra-high net worth into democratized wealth, mass affluent as well. And the participants in that will be not just the traditional incumbent wealth banks, there will be local banks and regional banks, and there will also be fintechs and new kinds of providers. So I do think that as you go forward, you will continue to see more activity and more participation and not less. So then you ask the question, can the business and the market sustain that? And my general view on that is if you think about Switzerland, there have been at least 50 really good private banks which have thrived in Switzerland for the last 200 years. So if you have a fast-growing market with good returns, it can actually support a lot of people, a lot of players. And people ask me, is this a precursor to consolidation in Asia? And so if you look at the top 10, 15 players in Asia, UBS, HSBC, JP Morgan, Citi, ourselves, you think any of them is going to get out of the business? I mean, it's highly unlikely. And therefore, you might see some kind of bolt-on changes from an inorganic standpoint, but I don't think anything fundamental. Now, what do you take away from this, though, is, and not just from this, but also from Silicon Valley Bank, is that you have to be thoughtful about the fact that the nature of the industry is changing. And the fact that we've all gone to a social media, internet-connected digital world has consequences and implications. You saw for SVB and for Credit Suisse that the market gets spooked very quickly. And when the market gets spooked, it can happen like this. In the old days, it would take days or weeks or months. Today, all you need is Elon Musk to put out a tweet, and 30 minutes later, or Peter Thiel, 30 minutes later, everybody's spooked. So you've got to start thinking a little bit differently about the stickiness of your AUMs, the stickiness of your balances, the quality of your customer relationships. And you have to have a different risk mindset around this. And that is a takeaway from the events of the last few months. But that's where I will restrict the takeaway to.
But then to your point, I mean, Credit Suisse also never thought it would be taken over. They wanted to continue, right? So, I mean, what would happen to the weaker players, right? I mean, or on the other hand, is scale more and more important for wealth managers to be relevant to clients?
I don't think so. Credit Suisse was number 2 or number 3 in the world. It didn't lack scale. So the reason Credit Suisse disappeared is not because it was a subscale industry or a subscale provider. It's certainly not the case. They had a whole bunch of other things, and fundamentally underlines an important thing, the issue of trust. Our industry is still all about trust. And when trust fades, then money disappears. And you really got to focus very hard on what keeps trust going. And like I said, in today's digital world, it's even more important. How do you make sure that the bar on trust is high and you don't suffer the consequences of that? I don't think, like I said, that you'll wind up saying, because you need scale, we should have one wealth advisor around the world. I don't think that'll happen.
So you don't really expect this to spur any round of consolidation in the wealth management sector?
I don't really, not at all. Like I said, my view is the reverse. I think there are more and more people coming into the sector and into the space. And it's a massive, massive industry. There's, I saw a Bain report recently that the total liquid assets in the system are expected to increase by $100 trillion in the next 7-8 years. Now, that's from 130, 140 trillion to 230 trillion. $100 trillion is enough to keep a lot of people going. Right? You take a 50, 60 basis point spread on $100 trillion, that's a heck of a lot of revenues being generated. That can help a lot of companies do quite well.
But just to sort of close the topic on this mega merger that we had, what would be, you said the takeaway is obviously trust and also look at how, CS didn't lack scale. But even otherwise, was there anything else that you as DBS or when you talk to clients, are they spotting any new trends when they see this massive merger?
I don't think there's a general trend. I think there's some tactical consequences of that. Obviously a lot of the wealthy people like to diversify their providers. And so people who already had exposures to UBS and now Credit Suisse also becomes UBS, they look for alternatives. There's quite clearly a movement of people, both voluntarily and involuntarily. So I think you will see some time for the dust to settle in terms of who benefits and who does not from this merger and in respect to where it is going. So you will see some of that.
But for now, on the other hand, has DBS benefited from this in terms of clients wanting to diversify?
I think we have. I think over the last year, and frankly, not just with the episodes in the last 3 months, over the last year, not just us, but we talked earlier about, you did a newsmaker with Julius Baer as well. I think a lot of the next bunch of providers have all benefited from the uncertainty around one of the players.
And for DBS, do you expect it to continue? Get more inflows because as a result of clients looking at second options and not just...
I think that's possible, though I do think that the situation is stabilizing in post the merger. But as we talk to clients, we still think that there is a tail of clients who are still conscious about the need to diversify, yes.
So when we look at the numbers, net new inflows at DBS have really been increasing in the last few years to hit $24 billion last year. How do you see net new inflows shaping up this year?
It's actually still pretty strong. I think Singapore continues to benefit from its position of being a neutral place, trusted place, good rule of law. And you think about the total assets under management in Singapore between 2016 and 2021, they doubled from $2.5 trillion to $5 trillion. So it's not just a short-term phenomenon. The total assets in the system over here continue to do quite well. And we are beneficiaries of inflows from North Asia, from Southeast Asia, which is our traditional footprint, but also increasingly from the Middle East, South Asia, and Europe. So it's a fairly broad and diversified set of people who are looking to Singapore, and actually more than that, looking to the region. So the reason some of the money is coming to the region is because people want to continue to participate in the opportunities that Asia throws up. And therefore, Singapore is actually a good place to be able to participate in those opportunities.
On the contrary, also, is wealth managers still a very attractive business for you all at a time when high interest rates are boosting your the commercial bank, right? In general, obviously it's a high ROE business, but you had low interest rates a couple of years ago, and now all banks are benefiting from high interest rates. So how do you look at the wealth management growth trajectory at a time when interest rates are going up?
Well, first of all, the wealth management business also adds to deposits. So depending on which part of the customer segment you're in, anything from 20 to 50% of wealth AUMs actually come in deposit form. And therefore, in a rising interest rate environment, the wealth management business also does well. They benefit from the uptick in rates. But perhaps more important, the wealth management business is a through-cycle business. And while it obviously gets impacted a little bit from market events and confidence, but you look at 5-7 years of zero interest rates, the wealth management business continues to do well, grow, and produce great returns. And then when you look at high interest rates, it's still not a bad place to be. For us at DBS, it's been the business has grown about 8x in the last decade. Today, it's a substantial portion of the bank, or 20% of the bank is wealth management, and it's a big driver of the improvement in our return on equity. So because you don't put that much capital to work, and if you can run an efficient business model, it's really about efficiency. We run one of the most efficient business models. Our cost-income ratios are about 50%. So with that kind of efficiency ratio, this is a fantastic business to be in.
So in terms of percentage as to the sort of group revenue, what could we expect generally? It's 20% of the business now. It comes from sort of very low base, and now you're the fourth biggest private bank in Asia.
Third one's Credit Suisse
Because
and
of the
UBS
UBS
disappear.
takeover.
Right.
So what would you expect in terms of how would this contribute to the share of the overall business?
I think it'll keep growing. I mean, I haven't modeled how big it gets, but the wealth management, in Asia, wealth management by and large grows at plus minus 10%. So high single digits to 10%. Nominal GDP growth is 5-6%. Well, the more millionaires being formed in Asia every day. So if you run a good business and you can actually gain share, there's no reason why you can't grow in double digits. And the rest of the banking system is very hard to grow double digits. So by the math tells you the wealth management will continue to be a larger part of the business of the bank.
Just moving on to sort of the hottest news in Singapore this year. And no, I'm not referring to Tharman's resounding victory. I mean, I think that was expected to some extent that he was victory, but talking about authorities uncovering one of the largest money laundering operations in Singapore. So not really good news, but at least they busted the scandal. So assets worth about $1.3 billion have been seized, and this has affected many sectors. I mean, banks, real estate, luxury sector, you name it. Banks, including yours, have been linked to the illicit flows, and local banks were supposed to have tightened practices after one MDB mess. We see fines being levied on banks, a number of banks. How is this kind of activity still possible, and has someone dropped the ball here?
Yeah, so first of all, Ajman, I've got to be a little careful. This is being investigated, so I've got to be thoughtful about my comments. It's still in the purview of the police and the authorities. But if you go back to the first principles, right, looking for illicit actors and illicit flows is like looking for a needle in a haystack. Right? And so, yes, you have to tighten up the system. You've got to use artificial intelligence, use technology to try and make sure you catch the bad actors. But to assume that you'll get 100% bad actors, it's like asking a country and saying, why do you have any crime in this country? Right? So you should have a good police force and you should have a good thing, and therefore you should have zero crime in a country, but no country can achieve zero crime. It's not dissimilar in the financial landscape. I often say, the banks are expected to be the global policemen. And we do that. We check for sanctions, we check for terrorists, we check for money laundering, and we use a lot of technology to do that. But at the same time, we're moving trillions of dollars and billions of transactions every day. And when you do that, we file suspicious transaction reports all the time. Less than 1% of the suspicious transaction reports actually result in anything. And the reason for that, therefore, is that we pick up anything. So tomorrow, if you are Anshuman, I've profiled you, I think this is what your transaction pattern should be. This is what you get paid in your job. And then one day you go and decide to buy a home. So now you suddenly do $1 million ticket transaction. My systems will throw it up, saying, hey, this is not usual to you. But if I shut down the $1 million transaction saying, hey, this is not usual to Anshuman, let him buy the home, and create friction, you're not going to be a happy person. It's a legitimate transaction.
Yeah.
So when we put in all our systems, even at 99.99% catching, you'll always find the stuff that goes through. And I think the good news is that the system was able to pick it up. The system responded well. The system, both from a legal standpoint, pursued it well. I think that's the best you can hope for, that there will always be things that sneak through. And in this case, if you look at the particular transaction, a lot of the stuff was actually happening not in the banking sector, it was happening in the real sector. So property transactions, club memberships, buying cars, etc. So it's almost impossible for the system to actually track every one of those things.
But frankly, for banks, there must be some learning out of this. I mean, when you saw the news, there must be some learnings that you would have had for the banking sector for this. I mean, give us some idea of what can banks do better.
The banks can continue to use technology better. Because at the end of the day, see, what do banks do? We first look to establish identity. I mean, you are who you say you are, right? And in this case, I think it was quite demonstrable. They were who they said they were. Then second, you need to start trying to figure out, are we comfortable that we understand where your money came from? Right? And by and large, the banks today do a fairly good job after one MDB, etc. The regulatory rules on this are very tight. The reason Singapore has a good reputation with FATF and all of the global this thing is the regime in Singapore, both the regulatory regime and practices, are quite tight about trying to establish who's who, where did the money come from, is it legit money, and so on. And then the third thing we do is we look at transactions. Are these transactions reasonable for you to be performing? Right? One of the things that happens when the transactions are on the asset side of the balance sheet, which is you're giving money to somebody to buy a house, right? It's a different profile than you're taking money from somebody where you got to be more worried about where did this money come from. If you look at a lot of the transactions, the banks are financing property purchases. There's a property, the property is worth 100, you give $40 of loan, you're relatively secured on your property and loan. So maybe you could dial up the scrutiny around that.
But again, I mean, while we have seen this unfold in Singapore, China has also been worrying about capital flight for the last few years. And in Singapore, there's been tension about the Chinese flow of Chinese funds, the arrival of rich people. Would that contribute generally to banks being more cautious?
I think banks are already more cautious since the GFC, the last 15 years. The amount of ops risk and operating fines that banks have had to pay for anti-money laundering, KYC, etc., have been enormous. And therefore, if I had to choose the one area where banks have really put in a lot of money, a lot of technology, a lot of investment, it is in AML KYC. And it's not just the physical people and bodies and technology, but some of the biggest advances in artificial intelligence and banking are in this space, trying to make sense. So fuzzy logic. So instead of DAGA, if somebody opens an account called GADA, we'd pick it up and say, okay, this is probably the same person. Links, we do network link analysis. So we actually put this thing saying anybody who's connected with you, if you think you're a bad actor, then we actually find out anybody who's connected with you and the artificial intelligence throws it up. So banks are already investing enormously in this. I think the key thing you got to take away is an assumption that there will be 100% and nobody will ever get through the system ever again. I think that's a misplaced and flawed assumption. Like I said, it's exactly assuming that there'll never be crime in a country ever again. Right? That's a flawed assumption.
Also, but I mean, just moving on, I mean, in terms of the flood of Chinese money that you've seen in Singapore, how do you see that distorting monetary policy in Singapore by inflating the property sector? Other parts of the economy are very sluggish. So first of all, has there been any inflationary impact because of the flood of Chinese money?
I think there is some, but it's overstated because the large part of the overseas investment has been in the luxury premium end. And it does create a lot of consternation and noise because you have apartments going for 30, 40, $50 million. But it doesn't actually impact the mass market. You talk about the property sector. I think the drive in the property sector has been homegrown demand. The upgraders from the HDB wanting to buy private properties in the $1 million bracket. That's not really impacted by foreign demand. To the extent that the government or the central bank was concerned about actually having some spillover effects, they've been quite forward-looking about putting in macroprudential policies. So the last set of measures, as you know, increased the tax on foreign purchases to 60%. And that's actually pretty draconian, 65 for an entity. I think that's already beginning to have an impact. If you look at the non-landed property prices in the second quarter, they've leveled off. Rentals as well as real prices.
But you agree there's a perception that this money is jacking up property prices? I mean, at least that seems to be a perception there. I mean, what can the authorities do to dispel that?
But the authorities have already done that, right? I mean, 60% tax rate, there's only for second and third purchases. I think the authorities are doing a fairly good job of trying to figure, how do you actually slow the flow of unwanted hot money?
And I mean, you talked about the real estate sector. I mean, that's obviously one sector which has bucked the global slowdown that we have seen. I mean, both the housing markets have almost grown at double digits last year. What kind of activity are you seeing in the mortgage market?
Slow down. Actually, the mortgage bookings this year are holding up because of a lot of new launches. But overall, if you look at the mortgage books of the banking sector, the mortgage books are flattish to down. So, like I said, you're beginning to see the impact of the central bank policies trickle through the system. Now, does it stay? I don't know. Typically, the policies create slowdown for 2-3 quarters, and then the market demand starts coming back as people adjust to the new pricing. Like I said earlier, the fundamentals of home ownership in Singapore are real. They're 90% home ownership, so the demand is real. One of the things the authorities do in that context, in the mass market, is they control the supply quite well. This year, for example, there were 40,000 HDB flats which will get built and delivered. I think over this year and the next 2 years, 100,000 HDB flats will be delivered. Now, that will calibrate the demand supply a little bit. So hopefully that will take some pressure off the property market.
So in terms of the property prices trend, I mean, do you think we are sort of hitting it will be stable from now on?
I think partly because of interest rates. As a general rule, when rates are at this level, then the froth disappears from the market. And I think you're seeing that the froth is disappearing.
And also, we're talking about loan growth, right? I mean, loan growth is also sort of pretty sluggish. What kind of signs are you seeing, would you want to see to expect a revival there? Or
I think it's the standard macroeconomic indicator. So GDPs are slow. China is slow. So that is a material impact. The rest of the region is slow. And so this is a normal economic cycle. I think by and large you'll escape a global recession, but without doubt you'll see a slower world. Now, so what happens, the interest rate cycle has to reverse. So once that starts reversing, then you'll see concomitant increase in GDP growth rates. And that is what will start driving lending volumes.
What's your expectation of Singapore monetary policy here? I mean, in terms of versus, I mean, are we at a peak here versus before the Fed peaks?
In terms of interest rates?
Yeah.
Unlike the US dollar itself, or let's say Hong Kong dollar, which is pegged to the US dollar, Singapore doesn't have an interest rate regime. As you know, all of monetary policy is operated through the currency. But if you look back historically, the Sing dollar interest rates track to about 65-70% of the US rates. So with US rates at 5.5, Sing rates would typically be 3.6, 3.7, 3.8, and so they're pretty much there. So I don't see a further increase in interest rates. I think you're done. And whether the rates come off is a different story. That goes back to the monetary policy, consider how much the central bank wants to sterilize. But I think you're pretty much done.
And obviously, one of the big worries this year has been the acceleration of China-US tensions. I mean, what do growing geopolitical risks between these two major countries mean for financial institutions in the rest of Asia? What kind of new risk do you have to manage?
Well, of course, the risks are obvious. And that's not just for financial institutions, that's for everybody. If you wind up in a bifurcated world, then you have an obvious issue of, how do you keep one foot in both camps? So unless you want to, say, okay, I only want to stay in one camp. I think China is so big and so integrated with the rest of the world, it's hard to divorce yourself from China. So I think most industries, companies and countries will want to try and keep a foot in both camps. And that's not easy. You can stub your toes and, wind up making mistakes when you do that. I think that's true for the financial system as for anybody else. Even if you can do it successfully, I think one of your challenges is you might have to increase costs, because if you've got to create two operating systems and operating models, then that's obviously a little bit more inefficient. I think the problem, though, is not just restricted to industries. It expands to countries themselves, right? So, how do countries play the game, and do countries sort of, vote to be in one camp or the other? My own view is that I don't think you're going to see a bipolar world as a consequence, because no country wants to bet on, one or the other. And therefore, I think what you will see is shades of a multipolar world. Sort of like Europe in the 19th century, where you had alliances which were shifting every decade. Different countries partnered with different countries. And they were all issues-based alliances. I think if you have heft and clout, if you're Saudi Arabia, or Brazil, or India, you will basically decide on an issues base where you want to be in the spectrum. Think about it.
What if you're Singapore? I mean, what does Singapore do?
Well, the same thing. You look at India right now, they're part of BRIC and they're part of Quad. So, they can play both sides. So Singapore's doing the same thing. We have our defense interests aligned with the US. We have our economic interests aligned with China. And they're both very important to us. Our whole positioning is that, we're straightforward, we're candid, we tell both sides what is in our interest and what we're doing for our own interests. And I think that's the way you have to try and play the game.
I mean, moving over to the Chinese economy, I mean, there's generally widespread disappointment over the weak economy. Even a 5% growth target this year looks unachievable, and economists are already downgrading estimates for next year. Is the pessimism about China overdone?
I think the short-term pessimism is not overdone. I think there's some real headwinds in China in the short term. The real estate sector overhang is material, and that's not easy to clean up. We saw in Japan it took a long time. And even earlier in the US, even the savings loan and other crises, property overhang takes a long time. Property is 35% of the Chinese GDP. And so it's material. And so how do you squeeze out the excesses in that is not straightforward. The economic model of the provinces is a challenge, as you know. They all sell land to get money, and now they can't do that. So that's creating a problem. That's spilling over into, wage cuts in the public sector. Consumption demand is slow, and overall confidence is slow. So you're not seeing. In fact, if you look at all the three engines, so China is hammered because exports are slow because global demand. Consumption is slow. Savings rates are high, but consumption is slow, and investment is slow. And so I don't think it's a short-term fix. I think they will continue to tactically, recalibrate to try and address the issues as they come along. But I think the bigger question to ask is medium long term. What are the prospects, and are those prospects fundamentally changed and different? And that's an important question. It's a very important question. If you think about, you could be in one of at least two broad camps. There'd be a camp which would say that the Chinese system now is ideologically shifting to the left. It's more concerned about the politics, about the party, about a public sector response to the problem. And if you believe that, then you'd argue that private sector, private enterprise, market economy is going to have long-term challenges. And if you do that, then you have to really consider and question, as somebody said, is China investable?
I mean, we've seen what happened to the tech sector. We've seen what happened to Alibaba. I mean, there are some measures there, but do you still see more pain for the private sector there?
It could be, but this is why I'm saying the alternate view to the ideological view is that, I call it technocratic view, is that they're trying to restructure and remodel the Chinese economy. I can tell you as a business person, to restructure and remodel a company takes several years. To restructure and remodel a country, if you expect that to happen in 2, 3, 4 years, you're smoking. It takes time to do that. But some of the things that they're trying to do, other countries have done over time. You take, tech sector, oligopolistic practices. The US did that 100 years ago, in the 1920s, with the end of the robber barons and the breaking up of Marbell. So these soft frameworks and institutions are actually very good for countries and economies in the long term. At some stage, you have to build them out. China then moved around rapidly in the economic part of this thing, but they hadn't put in place a lot of the soft infrastructure around it. So eliminating corruption. You think about Lee Kuan Yew did that in our country in the 1960s and 70s. It's been fantastic for Singapore, but you had to bite the bullet, and you had to go through a decade of pain to say we're going to clean the system. Right? So if you take what I call the more charitable view, that these are actions that the authorities are doing and they're willing to go through a short-term, medium-term pain to restructure the nature of the Chinese economy, then you could argue that there is a strong second rebound which will come in a medium term. Even in the short term, though, and this is for me as a business person, China might grow at 4 instead of 5 or 4.5. Does it really matter? I mean, in an $18-20 trillion economy, can I still find sectors and opportunities for growth? The short answer is yes. The EV sector is doing fantastically. Some of the modern tech sectors are doing fantastically. So there are large parts of the system where China is continuing to do well. And you've got to be nimble and make sure you focus on the right opportunities, and you can prosper with them.
But in the short term, has a weaker China led you to sort of change how you're thinking about it in terms of onshore wealth or sort of other business lines?
No. One of our strengths as a company is we are willing to look through cycle. And for all of these kinds of countries, you will go through cycles. And we pace it. So if you think there are headwinds, then we slow down, but we don't change strategy.
So what are you doing now in terms of China, in terms of slowing down? What are you slowing down there?
Across the board. So if you look at our loan book in China, it's been pretty flattish. We stopped doing property financing in China 3-4 years ago because we saw the property cycle coming, as an example. So we've been slow in growing the China credit exposures and loan books because of the headwinds. It would be silly to try and grow it in the face of those headwinds. But there are other parts of the business which are structural long term, and we continue to invest in those.
For example, DBS acquired a stake in the bank, Shenzhen Commercial Bank. I mean, again, you've talked about probably raising the stake also. When is that likely to happen, and how's it playing off so far?
It's working out well. It's a small stake. We're a minority shareholder. We're the largest shareholder, but still a minority shareholder. And it's a good bank. It's focused in Shenzhen. Shenzhen is, Singapore and Hong Kong are fantastic for us. There's no reason why Shenzhen won't be fantastic for us. It's a high returns bank. It's a clean portfolio. It's privately managed, and we're being able to work in close partnership with the management there to be able to influence the future growth and direction. So yes, we think we'll have the opportunity to up our stake in times to come. The other shareholders who would be open to rethinking shareholders, and eventually the bank will go IPO. And so we have the opportunity to change our position even when that happens. But that bank is good for us because it gives us a really good footprint into the Greater Bay Area. And again, like I said, China is slow, but within that, the Greater Bay Area is still doing quite well. Some of the high-tech industries, some of the supply chains in GBA, they're doing quite well.
So in terms of this particular bank, I mean, what is the next phase one could expect in terms of increasing stake? To what level?
It's difficult to say because some of these things are opportunistic in conversations with other shareholders and then, preparatory to IPO.
And when do you? What's the timeline like? When do you?
Also depends on the global markets. One of the reasons why the existing shareholders are willing for us to come in is apart from bringing internationalization and technology transfer is they were happy to take capital. So as the bank grows, it will need more capital. And so we think that will give us an opportunity to keep improving our position.
But it's fair to expect that you're looking for a majority stake if everything sort of lines up at some stage.
At some stage, yes.
Despite all this gloomy talk about China growth, which you said is up, it's fine. It's in the short term, it's pain, but long term, there's a good story going there. Banks have benefited a lot from high interest rates. We have seen that happen. And the digital transformation that you have had at DBS since 2014-15 has also helped the bank. It would double its profits. It was record last year and also year to date. The ROE is 15% last year and expected to top 17% this year. It's the envy of global banks. What's the next big contributor of growth?
Actually, our market shares are so small. Banking is a very fragmented industry. You talked earlier about, this consolidations and mergers. The truth is in every country, we're so tiny that there's a lot of headroom to continue doing a lot more of what we're doing. You take wealth management. It's like I said, it's grown 7-8x for us. We make, $3-4 billion. We're tiny in the big scheme of things. So could this industry continue to grow at double digit? Yes. Could DBS continue to gain share in this industry? Yes. We built another business in transaction services. So we do cash management, treasury services, trade finance. Singapore is a fantastic place for this. The energy and the attraction of regional treasury centers and people using Singapore as a transaction banking hub continues to improve. The Chinese are coming in here. The Westerners are coming in here. So can I see that we can double and continue to grow this industry in times to come? Absolutely. No reason not. You talked about our digitization. It's been actually very good. But it's taken us a long time to be able to convert that digitization to be able to penetrate domestic markets. Now we're finally being able to do that successfully. So markets like India, Indonesia and the region, we're tiny. Can we leverage our digital capabilities to grow that? Oh, absolutely. So I'm actually quite optimistic about our prospects and opportunities over the coming years.
Also you've talked about, DBS has built regional franchises, took over distressed Lakshmi Vilas Bank, which has a number of branches. You did a bold acquisition of Citi's Taiwan wealth business. How are these shaping up? As you said, some very small businesses now, but have prospects for growth. How are these shaping up?
Shaping up well. To be fair, Taiwan, we just integrated 2 weeks ago. It took us a year to get the technology. We wanted to integrate before we took it over. And the integration's been fabulous. It's gone well. The people are happy, and I'm quite excited. It's given us the scale in Taiwan now with the largest foreign bank for us to be able to make a decent return business. I think we'll do anything from between $1.3 to $1.5 billion in revenue next year. $250 odd million bottom line. That's not a bad business to be. India, we've been integrating for 2 years now. And that's also worked out really well for us. So we have a deep footprint in 5 southern states in India. Our brand is getting recognized. And after all of the tech and people integration got finalized last year, we are seeing the payoff this year. So this year, our customer base is up 20% already in the first 8-9 months of the year. Revenues are growing at 30%. The operating profits are growing at 50%. So we'll triple the India business in the next 5 years. And then again, like Taiwan, I think it'll be somewhere around 1.3, $1.5 billion in the next 3 to 5 years. That means these countries now start really moving the needle for DBS.
Which has not been the case till now. I mean,
We've been subscale. So if you look at, my general view on cross-border banking in the commercial and SME space, not corporate banking, large corporate, is that it's hard to do it in multiple markets and multiple countries, which is why many of the global players have been withdrawing. The reason for that is 25 years ago, you needed a little bit of capital to outcompete the local players. Today, every local player has the same technology, same access to capital, and same access to people. So you need a lot of capital to outcompete the local players. And you've got to recognize that these businesses have long payback periods. So you've got to hang in there for 8, 10 years before you get payback. So there are only limited number of countries and markets in which you can do that. Now, we've also been quite focused on day one. We said we'll focus on the 3, 4 big countries or big markets in Asia and focus our attention on those. So even with those 4 large locations and markets, we found it hard to scale quickly. But today, where we are with Lakshmi Vilas, with the city in Taiwan, I think we've hit inflection point in terms of scaling up. So I think some of these markets will now really start contributing back from a capital return standpoint.
I mean, for now, the overall, in terms of percentage, the businesses in Singapore contributes the bulk of it, and that's been the case probably even 10 years ago. It's not really moved. How do you see this changing in terms of?
Well, the good news and bad news. The bad news is that it hasn't moved. And, 10, 12 years ago, I was hopeful that we should be able to drive the Singapore contribution from 60% to 50%. So the bad news is we haven't. The good news is that most of the reason we haven't is because we outperformed in Singapore. And so I'll take that any day of the week, right? So our Singapore business has grown at high single digit, and in a mature market like Singapore, to get 8, 9% growth rates is not shabby at all. So I'm quite happy to do that. However, if you project out and you think, 10, 15, 20 years out, I do think it's important to have presence in countries which have large domestic markets. Our biggest presence are Singapore and Hong Kong. And while they'll continue to do well as financial hubs, they won't give you the opportunity that having a footprint in China or India or Indonesia can give. And therefore, I think you need to do both. Continue to hold and build a dominant position in the big financial hubs, but also try to see if you can scale up your presence in at least a couple of these big domestic markets.
I mean, you talked about, it's almost in inflection point in some markets. How do you see the share of overseas revenue for DBS changing the next 5 years?
5 years is early, this thing, because right now, we're still about 60. By the way, this is also a trick question because when interest rates are up, then the contribution of Singapore to revenues goes up because we have a dominant CASA franchise here. And so you mask the underlying split between onshore and offshore. But if you were to normalize for that, we're still about 60-40 today, Singapore and international. And while I don't have a specific number for the next 5 years, I think from here on, you will see the foreign contribution to this thing finally being to move.
I mean, one market that probably hasn't panned out the way you want it to be, if I might say, is Indonesia. What are your plans there in terms of increasing strategy and allocating more capital?
The problem with Indonesia has been, in both Taiwan and India, as I said, and even in the Greater Bay Area, we were able to find an appropriate opportunity to add a bolt-on deal that gave us scale. In Indonesia, we've not been able to find that opportunity. The Indonesian market is also very rich. So you have to pay 3.5, 4 times book to look at a deal, and it's kind of hard to make the economics work on the back of that. And so our current approach in Indonesia is continue to grow organically, which means it will take a little bit longer compared to countries where we've been able to get a leg up, if you will. However, Indonesia is still very important to us. And Indonesia's importance for the region, Southeast Asia, and its connectivity into Singapore, I think that's actually underappreciated by a lot of people. So we will continue to bet on Indonesia. At the right time, if we get the right opportunity to bolt on in Indonesia, we will take that up as well. But in the meantime, the organic strategy is slower, but it's still doing well.
So are the valuations still high for you to look at?
Still very high. Yeah.
And how about Vietnam? I mean, that's a market that not in the sort of core 5 markets, but again, with so much attention on Vietnam and becoming sort of an alternate supply chain provider, how do you see Vietnam?
Vietnam is like many other countries for us where the corporate franchise, we will do, the network banking, we will do. But to try and build a domestic franchise, I'm sure Vietnam is a good country, is you've got to pick and choose your battles. And I go back to the comment I just made a few minutes earlier. I think opening up too many fronts on the commercial banking, consumer and SME front is actually a little bit risky. Because you have only so much management bandwidth and only so much capital in terms of how many opportunities you take on. And so our strategy is saying, since we have limited limitations, let's just focus on the four big markets in Asia, ex-Korea, and stick to those and try to make 1, 2, 3, or 4 of those work. I think is still the best strategy.
So, I mean, in terms of allocation of capital of the next few years, what can you expect? I mean, is India or which markets would get the bulk of your allocation of capital?
I think you will see greater allocation of capital to all of these: India, Indonesia, Taiwan, even China. You will see more allocation of capital to these markets. Yes.
And you spoke about China.
And one of the reasons for that is just the math. Singapore and Hong Kong throw off capital, right? Whereas some of the other markets are still in investment mode, so they soak in capital.
You spoke about China, just going back, I mean, as you said, you're not really too worried about the short-term trend and sort of, there is pessimism in the short term also. But if you project a few years later on, what can DBS achieve in China in the wealth management space and through this Shenzhen Rural Commercial Bank?
I think we'll always be tiny. So the truth is the entire banking system, international banking system is like 1.3% of China. So we will never be very consequential in that scheme, but China will be consequential for us. China is important to us, remember, is twofold. It's not just the domestic market and domestic opportunity in China. It is the spillover that we get outside China. Even today, we make a lot more money off Chinese companies and Chinese business internationally than we make of Chinese companies and business on the ground. It's a big driver of our business in Hong Kong. It's a big driver of our business in Singapore. It's a big driver of our trade connectivity business. It's a big driver of our foreign exchange business with the internationalization of the RMB. So that will continue to be the case. China is the big enchilada in our region. It's a $18-20 trillion economy. So you have to expect that the spillover impacts of China are very material.
And also in terms of, you also spoke about India, and it's coming from basically negative ROE to positive ROE, right? In terms of scale, but do you see that coming back to sort of being a bigger market than sort of other markets here?
Yes, because in India, after the deal we've done, we now have a complete full-service platform. In fact, outside of Singapore, Hong Kong in fact, maybe even Hong Kong is the most complete platform we have. And we can now bank every segment of the market. And we're doing that. We're doing consumer, we're doing asset-based financing, gold loans, property financing, SME, mid-cap, large corporate. And we have 500 branches over the country. So we have a complete network. And we have every capacity capability today in India, which every local bank does. So I think the best way to think about India for us is that, many of the banks which were formed 10, 15 years ago in India have been able to make the India operation quite sizable. We are at the beginning of that journey. I think over the next decade, we should be able to do what many of these private sector banks did in the previous decade.
But there must be tough competition. I mean, look at the likes of, there's such an active sector. You saw Kotak take over Citi's wealth business there. I mean, how do you see that shaping up?
It's again, you got to remember, so the banking sector penetration in India is low. It's emerging economy. The growth rates in India, the industry growth rates will be material. On top of that, there's a secular shift of wallet from the public sector banks to the private sector banks. And there, yes, it's competitive, but there are 4, 5 material big banks. So could 10 banks do well in India? I think the answer is yes. Finally,
Piyush, DBS has come a long way since you took charge in 2009. I mean, profits are at record. Total shareholder returns are 12% annually, beating the likes of HSBC and Stanchart and all. And you are probably one of the longest running CEO of a major bank in Asia. What's next for you? Do you have a short runway before you look at handing over the reins?
Well, we don't have specific timing. But I think it's fair to say that I'm enjoying myself. I enjoy the job. And the reality is that our industry and sector keeps evolving and changing. So the job I'm doing today is quite different from the job I did 10 years ago, even the job I did 5 years ago. So AI, Gen AI, blockchain, Web 3.0, there's a whole, fascinating new world out there. So when it gets to a stage where I say, okay, I'm tired of this, I think of hanging up my boots and going and doing something else. But that's not imminent.
But I remember, 2017, we interviewed you in the same room and asked about succession planning. You had told us that you're 57, you have a reasonable runway, and now you have reached Singapore's official retirement age of 63. I'm not saying that is the age where people really retire, as you had reminded me last time. But what do you see in terms of, banks, as we see with in India with Kotak Mahindra Bank and with others, there needs to be sort of a proper succession planning and all. And you think you've already sent that message across?
Yes, of course. First of all, you might want to ask the question of Jamie Dimon. He's 69.
We were just betting internally whether you would say that or not,
Yeah, but we have a very robust succession planning process, and it's been in place for every position, including mine, for the last 10 years. So we are quite rigorous about it. And we move people around, we plan their careers, we do development of people. It's quite instructive that, first of all, we have a very stable senior management team. We haven't lost a lot of people. But wherever we have had people retire, we've always filled it internally, which means we have enough bench strength and we grow people into jobs. And that's true for my job as well. We've identified candidates who could step up and do my job. And we worked, the board has worked assiduously to make sure that they're ready to be able to do that when the time comes.
So, would you be available for an interview in the same role in 3-4 years?
That's quite likely, yes.
That's good.
It depends on whether you want to interview a naturalist or a banker.
Exactly, yeah. Just talking about that, whenever you decide to move on from DBS, what would you most look forward to doing?
I'm deeply interested in conservation issues and nature. My hobby is bird watching. I am the co-chair of the advisory committee of BirdLife International, which is actually the largest conservation organization in the world. So I anticipate doing a lot more in the space of conservation and nature, if you will. As I chair the university here, which I enjoy, the SMU, which I enjoy thoroughly. So I think I have a lot of eclectic interests.
So this is fair to say this would be your last big corporate job?
I think that's a reasonable expectation, yes.
Great, thanks. You want to open up for questions? Yeah, please, go ahead.
Thank you so much for that interview. Really insightful. You're amongst your other passions outside of your day job. You're also on the Council for the Ethical Use of AI, and here at LSEG, we're working closely with Microsoft on several possibilities. I wondered if you could speak a little bit on what you're most excited about in the space, and maybe what keeps you up at night and what you fear the most, perhaps.
Yeah, I think, frankly, AI and Gen AI is a complete game changer. I think some of the, people say this, and I've said it myself over the years, that, we're at a historic cusp in a time in humanity, etc. But this time, I really believe that over the next 5-7 years, the remainder of this decade, there are 2 or 3 big things happening which are going to be fundamental to us as humanity and civilization. And obviously, the climate issues are one, everybody knows them, and I think social tensions are coming to the fore, I think. But one of the ones that worries me the most is how we're going to deal with AI and Gen AI. At DBS, we've been working with AI now for a decade. So we were the first guinea pig for IBM's Watson in 2013. Then we set up some labs with A-Star over here, in the next 2-3 years. We invested in an AI company called Kaikassisto out of New York. We used them to develop our chatbots and so on. So we've had a history. And every time, particularly natural language processing, conversational, etc., I thought AI wasn't there. In the Watson days, my vision was that plug AI into a Reuters or a Bloomberg on one side and client portfolios on the other side, and it would read everything and just do everything. And it didn't work. AI, the natural language processing was based on sentence parsing. It didn't understand double negatives. It couldn't read bars and graphs and pictures. It couldn't read PDFs. So it was clunky. And then by the time we got to the chat bot, even then we had to morph it because it couldn't really do conversations. So we morphed it eventually into guided conversations, right? So to help but guided conversations. The stuff we are seeing today is dramatically different. And so we're actually already working on it, and we can see the impact, whether it's in software coding and user testing, anything to read, synthesize, and write. GenAI is extraordinarily good. And it's good enough to actually be able to do conversational stuff. So you can finally think of avatars talking to you in real time. So I think there are two implications. One, there will be a massive productivity implication. Companies are doing that. We're seeing that ourselves. We expect to be able to get productivity of the order of 30-40% in our technology, in our coding, and in several in our call centers. And I'm not talking 5 years out. I'm talking over the next 12, 24 months. So what that means, of course, therefore, is job displacement. The positive spin is productivity. The negative is people will have to look for new jobs. Now, we've so far always been able to rescale up people and find roles for people as we've digitized. And we hope to continue to do that, but I'm not sure at an industry level. Long term, I think jobs get created. Every time technology comes, jobs get created. But in the short term, there is dislocation. So when the stagecoach disappeared and the cars came, and the stagecoach drivers didn't automatically find the jobs, and overall jobs got created. So one challenge is that the opportunities are very real, but there will be dislocation of jobs, and there will be disruption that we all have to be able to negotiate our ways through. The bigger challenge, the dystopian view of me says, how do you start making the distinction between human beings and computers and robots in the future? And I think that's a real issue. So this idea of what makes us human beings, and is there a soul, and can robots and computers understand emotion and understand intent as well as people do? It's unclear. But if you look at what the AI and robots are doing today, it's scarily similar. They're able to today figure out what's your tone of voice. Are you angry? Are you happy? Are you sad? Should I respond? And if you can do that, then, at least superficially, how is that very different from the emotions that human beings express to each other? So I think the biggest challenges we're going to face in the rest of this decade are challenges of the social sciences, challenges of philosophy. What are we willing to live with? Where do we draw the boundary lines? Where do we say these are markers that we want to be very careful about because we don't know which paths we're going down? And therefore, both at the national level, the council you talked about, but even at DBS, we spend an inordinate amount of time thinking about what is the right thing to do. We have a committee and a set of principles we call PURE. So purposeful, unsurprising, respectful, and explainable. And we put everything, all our models, we run tons of AI models, all our data to say, is it the right thing to do? But the truth is that's also very, very hard. The right thing to do is not binary. How you feel about it in the morning is sometimes very different from how you feel about it in the evening. Or, if you're a young person, you feel very differently from an older person. So these are very subtle and very nuanced. I do worry about that a lot.
Thank you. Any other questions? Maybe this idea. Please go.
Yeah, thank you very much for this interview. Stéphane Latouche, Banque de France. You said IA could be a game changer. I would like to hear you about climate change. Would you say it could be also a game changer for the financial industry, the banking industry? Do you consider it can be a real financial risk as of today and perhaps tomorrow? And how do you address it for DBS? Thank you.
So I think, yes, climate change is as much a game changer as AI. The time frames, I think, will be slightly longer. But the risks, like with AI, there are risks and opportunities. So on the risk side, like most other companies, you focus on both the transition risk as well as the physical risk. The transition risks, government policy is going to be architected to helping with the transition. And the most obvious parts of government policy are tax regimes and capital regimes for banks. Tax regime really means if you start up with either carbon taxes or carbon border taxes as in Europe, that changes the cash flow and EBITDA of companies because you're taxed. So you've got to start factoring in, which company survives, which doesn't. Even if you survive, what does it do to your cash flow? What does it do to EBITDA? Who will succeed and who will fail. So you've got to be conscious of that. Physical risks are slightly trickier because physical risks, you take Singapore, so do I worry about seawater levels rising a meter and therefore Changi and the eastern parts of Singapore getting flooded? Yes, I do. But does that mean I should stop doing mortgage financing there today? I might not, because the government is already taking action. They're putting $100 billion to build the dikes and build the dams and build the islands. So I've got to take into account the consequential actions people will take and how we should respond to that. Nevertheless, I was in Hong Kong yesterday after the big black rain flood. I happened to talk to a couple of insurance clients, and they're already looking at changing the insurance premiums for property for next year. And one of them said there are actually some properties which will be uninsurable, they will not insure them. So without a doubt, there are risks, and we actually have a whole focus on that. On sustainability, we're one of the leading banks in the world. So we have a transition pathways. We wrote a very ambitious plan last year for 9 sectors, how we're going to get from a carbon-intensive business model to lower carbon-intensive, how we can help our customers, etc. But we focus very hard on the risk. But the flip to that, like AI, I'm schizophrenic. I think the opportunity is also tremendous. We have trillions of dollars of extant infrastructure in the world, which embeds a very high carbon-intensive business model. And I think over the next 10, 15, 20 years, all of that is going to be replaced with a low carbon-intensive business model and therefore completely new infrastructure. That requires financing. So that's a real opportunity. I think carbon credits, for example, or carbon-based solutions, I think they will be right. I think carbon markets will be the biggest things coming. So we had launched a carbon exchange in Singapore. We are shareholders of that. And we're doing that because we really think that there's going to be a massive asset class. And so to being able to participate in that asset class is a real opportunity. And we're creating a whole bunch of other opportunity to work with our clients. We announced recently a partnership with Keppel. There were a lot of energy saving solutions for SMEs. And so in partnership with them, they provide the solution, we provide the financing, and we roll it out to the small and medium enterprises around the region. So there are some real opportunities for banks as well.
One last question, please.
Well, thanks, Mr. Piyush, for your generous sharing of a perspective. Just two quick questions.
Yeah.
I'm conscious of time. So the first one, just to continue on the AI thread, very clear that there is very exciting application on AI. What about the governance of AI? Well, a lot of communities and governments themselves are very concerned about it. Number one. Number two is the recent MAS framework on stablecoin. Just like to get your views on these two questions and see where stablecoin in Singapore, in the region, or Asia Pac, or wider, in how does it impact payment as per se, and the safety as well? Thanks.
Yeah. So on the first question, I think I've already touched on that. I think the governance is important, right? Because like I said, the risk issues are material, and therefore we can put external governance, but I think to a large extent, you need to create governance at the entity level. And we do that. So we have some very tight mechanisms for governing models, model bias, hallucination, appropriateness, suitability, and you need to build that whole architecture. So the more you use AI, the more you need to have a governance architecture around it. On the second question of stablecoin, I think the general, I'll go back to first principle. In the domestic space, I think by and large, money serves the purpose it's intended to serve, and infrastructure is developed enough for people to be able to get real-time payments, even QR code based. So over here you go, you can just PayLah at every kiosk and make the payments. And so digital money gives you really minimal value add. However, in the cross-border domain and in the global space, the payments architecture is still a little primitive, it's clunky. And most settlements take T+2, so there's an opportunity there to change that paradigm. And you can change the paradigm with either you call them wholesale CBDCs or some kind of stable coin, which allows you to transfer value and information in real time at the same. Today, information goes separately, settlement goes separately. If you can collapse them, then you can actually make a difference and get true value outcomes. And therefore, whether you call them stable coins or wholesale CBDCs, I think there's a role to play.
Okay. We've got out of time. Just one question from the news side. In terms of, Piyush, asking you, so that we can get a news headline, obviously. In terms of, we didn't talk about this in terms of the outlook for the capital markets and M&A. It's been pretty muted. You're seeing ARM IPO. What are you seeing from clients?
I think there's a big pipeline of activity, but the outlook is muted because confidence needs to come back. In the meantime, the private markets are still actually quite active. Both private debt and private capital is still active. Valuations are down, and so people are beginning to judiciously put more money to work.
But you see, it's sometime before we have the IPO markets opened up again.
I don't see the IPO markets coming back in the rest of this year.
Rest of this year, okay. Great. Piyush, you never fail to surprise us with your deep insight across so many topics and your openness to answer all questions. We're so glad you could spend your afternoon with us. Audience, please join me in giving a big round of applause for Piyush.
Thank you.
Thank you. Thank you, Anshuman, and thank you, Piyush. I was struck by a phrase you used then about the energy and attraction of Singapore. And as a visitor here, it really feels like that this week, which, you know, may be fueled a bit by the F1, but it's a really great feeling to be here. For those in the room, we'll take a short 10-minute break. If we could please aim to be ready for our next speaker at 1:15. And for those watching on the live stream, we will be back with you then with our next speaker. Thank you.
In the world of finance, names can be a bit misleading. Take ours, for instance, pronounced LSEG, aka London Stock Exchange Group. Sure, we're in London, but we're also here, here, and here. In fact, we do business in 190 countries. We're practically everywhere, except here. Well, not yet anyway. We're proud to be one of the world's biggest, most international stock exchanges, connecting capital with ideas for centuries. But that's just part of what we do. Today, we connect the news, information, insights, and systems to create possibility across the markets, partnering with almost every major financial firm in the world. You see, others do some of what we do, but not everything we do. Instead of LSEG, we could have called ourselves the London and practically every other place in the world stocks, bonds, currency data, analytics, indices, risk management, clearing, exchange, multi-asset class group. But that's a little wordy. LSEG. In the world of finance, names can be a bit misleading. Take ours, for instance, pronounced LSEG, aka London Stock Exchange Group. Sure, we're in London, but we're also here, here, and here. In fact, we do business in 190 countries. We're practically everywhere, except here. Well, not yet anyway. We're proud to be one of the world's biggest, most international stock exchanges, connecting capital with ideas for centuries. But that's just part of what we do. Today, we connect the news, information, insights, and systems to create possibility across the markets, partnering with almost every major financial firm in the world. You see, others do some of what we do, but not everything we do. Instead of LSEG, we could have called ourselves the London and practically every other place in the world stocks, bonds, currency data, analytics, indices, risk management, clearing, exchange, multi-asset class group. But that's a little wordy. LSEG. In the world of finance, names can be a bit misleading. Take ours, for instance. Pronounced LSEG, aka London Stock Exchange Group. Sure, we're in London, but we're also here, and here. In fact, we do business in 190 countries. We're practically everywhere, except here. Well, not yet anyway. We're proud to be one of the world's biggest, most international stock exchanges, connecting capital with ideas for centuries. But that's just part of what we do. Today, we connect the news, information, insights, and systems to create possibility across the markets, partnering with almost every major financial firm in the world. You see, others do some of what we do, but not everything we do. Instead of LSEG, we could have called ourselves the London and practically every other place in the world stocks, bonds, currency data, analytics, indices, risk management, clearing, exchange, multi-asset class group. But that's a little wordy. LSEG. In the world of finance, names can be a bit misleading. Take ours, for instance. Pronounced LSEG, aka London Stock Exchange Group. Sure, we're in London, but we're also here, and here. In fact, we do business in 190 countries. We're practically everywhere, except here. Well, not yet anyway. We're proud to be one of the world's biggest, most international stock exchanges, connecting capital with ideas for centuries. But that's just part of what we do. Today, we connect the news, information, insights, and systems to create possibility across the markets, partnering with almost every major financial firm in the world. You see, others do some of what we do, but not everything we do. Instead of LSEG, we could have called ourselves the London and practically every other place in the world stocks, bonds, currency data, analytics, indices, risk management, clearing, exchange, multi-asset class group. But that's a little wordy. LSEG. In the world of finance, names can be a bit misleading. Take ours, for instance. Pronounced LSEG, aka London Stock Exchange Group. Sure, we're in London, but we're also here, and here. In fact, we do business in 190 countries. We're practically everywhere, except here. Well, not yet anyway. We're proud to be one of the world's biggest, most international stock exchanges, connecting capital with ideas for centuries. But that's just part of what we do. Today, we connect the news, information, insights, and systems to create possibility across the markets, partnering with almost every major financial firm in the world. You see, others do some of what we do, but not everything we do. Instead of LSEG, we could have called ourselves the London and practically every other place in the world stocks, bonds, currency, data, analytics, indices, risk management, clearing, exchange, multi-asset class group. But that's a little wordy. LSEG. In the world of finance, names can be a bit misleading. Take ours, for instance. Pronounced LSEG, aka London Stock Exchange Group. Sure, we're in London, but we're also here, here, and here. In fact, we do business in 190 countries. We're practically everywhere, except here. Well, not yet anyway. We're proud to be one of the world's biggest, most international stock exchanges, connecting capital with ideas for centuries. But that's just part of what we do. Today, we connect the news, information, insights, and systems to create possibility across the markets, partnering with almost every major financial firm in the world. You see, others do some of what we do, but not everything we do. Instead of LSEG, we could have called ourselves the London and practically every other place in the world stocks, bonds, currency, data, analytics, indices, risk management, clearing, exchange, multi-asset class group. But that's a little wordy. LSEG. In the world of finance, names can be a bit misleading. Take ours, for instance. Pronounced LSEG, aka London Stock Exchange Group. Sure, we're in London, but we're also here, here, and here. In fact, we do business in 190 countries. We're practically everywhere, except here. Well, not yet anyway. We're proud to be one of the world's biggest, most international stock exchanges, connecting capital with ideas for centuries. But that's just part of what we do. Today, we connect the news, information, insights, and systems to create possibility across the markets, partnering with almost every major financial firm in the world. You see, others do some of what we do, but not everything we do. Instead of LSEG, we could have called ourselves the London and practically every other place in the world stocks, bonds, currency, data, analytics, indices, risk management, clearing, exchange, multi-asset class group. But that's a little wordy. LSEG. In the world of finance, names can be a bit misleading. Take ours, for instance. Pronounced LSEG, aka London Stock Exchange Group. Sure, we're in London, but we're also here, and here. In fact, we do business in 190 countries. We're practically everywhere, except here. Well, not yet anyway. We're proud to be one of the world's biggest, most international stock exchanges, connecting capital with ideas for centuries. But that's just part of what we do. Today, we connect the news, information, insights, and systems to create possibility across the markets, partnering with almost every major financial firm in the world. You see, others do some of what we do, but not everything we do. Instead of LSEG, we could have called ourselves the London and practically every other place in the world stocks, bonds, currency data, analytics, indices, risk management, clearing, exchange, multi-asset class group. But that's a little wordy. LSEG.
Welcome back to this Reuters Newsmaker event hosted by our partner LSEG here in Singapore. After a great conversation with the DBS CEO Piyush Gupta, I'm delighted to be moving on to an interview with EDB Managing Director Jacqueline Poh, hosted by my colleague Jingwei Kok, our Chief Financial Correspondent here in Singapore. Please welcome them both to the stage.
Hi, Jackie. Thanks for joining us today and during such a busy week.
Thank you very much.
Yeah.
It is an incredibly busy week, and I think a lot of your audience will be in many events this week. So stay healthy, take your vitamin C.
Yeah. So let's start with the investments that Singapore attracted last year. It was a record $22.5 billion, right? What were some of these investments, and were there any interesting items manufactured in Singapore that would surprise our audience?
I think that the record investments are largely related to fixed asset investments. In other words, on the ground manufacturing factories and so on. The main driver for the record amount of investments was actually the semiconductor super cycle. So as many of you recall, during COVID, the amount of smartphones, the number of data center equipment, servers, the amount of money being placed in consumer electronics was actually on a very, very sharp increase. And this created a large demand for chips. So as a result, there was a big boom in investments into wafer fabs, semiconductor tools companies, and so on. And this drove a lot of the committed investments from last year. The investments are committed, so they are representing shovels in the ground projects. So they will take place regardless, and they will be a great addition to the manufacturing capacity that we have in Singapore for chips.
I think with the year in review this year, I think EDB said that there was a semiconductor super cycle, but you expect it to slow down, right?
Yes, we fully expected and anticipated, even at the beginning of this year, that the super cycle was coming to an end. It has come to a rather abrupt end, and now there is an electronics downturn. And the electronics downturn is shaping up in a lot of our export numbers, and it's shaping up in the GDP numbers that we're seeing for this year, which is a much more muted, I think, number of close to about 1% this year. So we are expecting, of course, for this year, the FAI performance to be a lot more muted compared to last year, but well within expectation and well within our medium-term targets, which is roughly between $8 to $10 billion.
But talking about FAI commitments, I think if we look at the numbers from 2021 and 2022, investment commitments from China in Singapore has grown, right? Whilst investment commitments as a percentage from the US have fallen. Given China's current slowing economy, do you think this would impact their investments in Singapore in the years to come?
I think that the base that you're looking at is quite different, and also the kind of investments are also different. I think the numbers you're referring to are what we call total business expenditure, which is a sort of a different metric of foreign direct investment compared to fixed asset investment. No matter which way you look at it, the largest investor in Singapore continues to be the United States. There are roughly about 5,700 American companies in Singapore, and they continue to have a certain amount of confidence to invest in Singapore and continue to put investments in Singapore. They are followed by Europe and also Japan. So China still makes up for a relatively smaller share in terms of both our fixed asset investments as well as our total business expenditure. Now, we have been seeing that investments from China, India, Southeast Asia are increasing in the last few years. This is actually largely due to the shifts in the economic weight of Asia as proportion of the GDP of the world. So Asia is a very fast-growing region. Southeast Asia alone is expected to grow 4-5% every year until the end of the decade. It's expected to grow by about 4 to 5% this year alone. So we would expect that with that shift in economic weight, you'll see more investments coming from this part of the world compared to in previous decades. This is also coupled with the fact that many companies in Asia, whether in China, India, or Southeast Asia, are starting to have capabilities and global ambitions. That means that they want to expand out of their domestic markets. They're finding that they may even have saturated their domestic market if it's a small enough market, say in Southeast Asia. And they are looking at expansion regionally. They're looking at expansion globally, including to places like Africa, to Latin America, and Europe and the rest of the world. So these investments that we're getting, particularly from Asia, are sort of in anticipation of a global expansion plan.
So when EDB goes out to attract all of these foreign investments, right, are there any industries that you typically focus on, and do geopolitics play a part in how you decide what to focus on?
I think the kind of industries or sectors EDB has focused on has changed a great deal over the years, and they reflect what is most likely to provide good growth for Singapore, good jobs for Singapore and Singaporeans. And that's generally what we are looking out for. Based on this, we look for sectors that have good growth potential and are also that also suit the resource profile of Singapore. So, for example, we're highly unlikely to go for a steel-making plant because we don't have any of the natural resources. It wouldn't fit our resource profile, would take up too much land, and very few Singaporeans would want to be steelmakers. So we go into industries that we think that have got great potential and provide good jobs for Singaporeans, particularly as measured by salaries and good salaries. Some of those jobs are in advanced manufacturing. Many of them have come to be in the digital economy and increasingly in areas like generative AI, but also in areas like cybersecurity and fintech, B2B SaaS, and e-commerce. More recently, we've been looking at jobs in the green economy because sustainability is a big feature of what we need to do in terms of decarbonizing our own industries, as well as a driver of growth for the world. So we are increasingly looking at jobs in, say, carbon services. Just in the last 2 or so years alone, Singapore has brought in roughly, depending on how you count it, 70 to 90 carbon services firms into Singapore. And a lot of them provide the kind of jobs that Singaporeans do want to do. These could include monitoring, verification, and reporting, carbon accounting, finance, green and blended finance. Also, a new area which is quite interesting, which is the renewable project development. That is the development of solar or offshore wind or onshore wind or hydropower or geothermal projects in other places. And a lot of that is done through Singapore. So this has been a very interesting area of expansion for us. One of the other big areas we think that we may have a competitive advantage in, as well as provide jobs Singaporeans want to do, is healthcare. With an aging population, Singapore is a blue zone. It was most recently announced to be the world's 6th blue zone. We have a very long-lived population. And we have also got a very robust biopharma manufacturing industry, where we can take that in terms of biotech, precision medicine, medtech, and digital healthcare will be a very interesting set of prospects for our workforce in the years to come. When we look at these industries, we think about how we want to do industry development to make them grow, to create a flywheel effect, and to ensure that regulations, talent, infrastructure are all provided. Once we do that, we are looking for companies that are global leaders in those fields, global or regional leaders in those fields. So very often that's how we choose companies. They have to be profitable, sustainable, and have a great deal of competitive advantage. Geopolitics only matters insofar as it may affect the ability of any company to prosper, their own sustainability, their own economic viability.
It sounds like this requires a lot of planning in advance, right? To identify industries that could bring growth and jobs to Singapore.
Yes, the Singapore government is nothing if not a long-term planner. We've been doing scenario planning for a long time, but also we have many eyes and ears around the world, scouting out what companies are telling us, basically what businesses are telling us, what research institutes are telling us. And we work very closely with other agencies like Enterprise Singapore, the NRF, and A-Star, Temasek, which is, together with GIC, who also have insights on what might be the next big thing.
So what are companies and businesses telling Singapore? What is it about Singapore, this small country, that's so attractive to these industries, to advanced manufacturing, to biopharmers?
I think that the first thing about Singapore is that it's a safe haven. It is a very stable country. We are known for being predictable. We are known for respecting rule of law. And in the particular geopolitical, geoeconomic environment that we find ourselves, that is no small feat. So it is greatly appreciated that we are a stable country. The other thing that they look for is connectivity and access to a fast-growing market. And in that regard, Singapore's position in ASEAN or Southeast Asia, being part of such a fast-growing region, as I've mentioned, 4 to 5% a year, and being a region that has 650 million people, many, many very young people becoming increasingly digitally literate populations, and likely to be the world's 4th biggest economy by 2030. That's a big plus for us. We are sort of smack in the middle of growing Asia. And we have the connectivity, both as a maritime hub and as an aviation hub, to be able to exploit a lot of the benefits of this location. So I think that's the second major reason. The third one is actually innovation and our willingness to protect IP, to pour in money into R&D, to push companies, whether Singapore companies or foreign companies, to have an innovation mandate in Singapore, to have a product charter in Singapore, to build products out of Singapore and design and build products out of Singapore. That's a big thing for us. Some time ago, as you know, we committed $25 billion until 2025 as part of the RIE 2025, which is the Research Innovation Enterprise Fund. So roughly about 1% of our GDP goes into this research. That is then complemented by a fairly large amount of what we call business expenditure on R&D. And that amount from firms in Singapore has been growing very steadily over the last 10 years. So the two combined have made us quite a formidable innovation hub, the place where you can do R&D, place where you can do data and digital work. And that's quite a competitive advantage. To be able to do that, you need talent. And I think the availability of world-class talent in Singapore is quite important. So we have homegrown talent, we have regional talent, and we also have global talent. So the amount of work that's been put into making 2 of our universities in the top 20 within the world, one of which is ranked number 8 in the whole world, has been not inconsiderable, and it has taken decades and decades to get there. But that means that our homegrown talent have a certain caliber. And that's very attractive to companies, especially when we tell them that there are also polytechnics, ITEs, and so on, that ensure that the skill sets of our people match the needs of the industries that we're bringing in. Then we also have regional talent from all around us. And we have global talent that we've been trying to be quite welcoming towards global talent by introducing a number of new visas. So some of you will know that we have employment passes. We've streamlined that process. We have something called Compass, which is a complementarity assessment, which recently came into effect. That was in response to the calls from business to make the EP application process far more easy and transparent, so that now it is a points-based framework with extra points given to shortage occupations and you can play around with it until you know that you've really got the right person with the right salary in the right position with the right amount of diversity within the workforce. And that gives a huge amount of certainty to companies. There's also been the Tech Pass. The Tech Pass is a 2-year pass for proven tech talent who have scaled and built big companies before or been part of those teams. So as of now, we have about 330 Tech Pass holders, and they come from many countries around the world. Many of them are from Silicon Valley, and they have come to Singapore to fulfill roles like CTO, CEO, to found companies, to work with VCs to select good tech companies within Southeast Asia. Some of them even sit on boards. They teach in our universities. They mentor our startups, because the Tech Pass is not particularly tied to any one employer. It gives a large amount of flexibility. We extended that flexibility to the One Pass, which is the Overseas Networks and Expertise Pass. For those who qualify for the One Pass, which is generally a 30,000 monthly salary or special talents and skills, again, that flexibility remains to do a portfolio of activities in Singapore. It also allows for letters of consent for spouse working, and it is a 5-year visa. So that one has also been extremely attractive. Some of you in this room may be recipients of the One Pass. So a range of things that we've done to make ourselves very welcoming to global talent, then the right kinds of global talent is the sort of the third piece in this puzzle. So stability, innovation with talent, and being location, being as part of a fast-growing region. If you think about it as 3 corners of a triangle, stability, innovation, and location, there are very, very few other global cities that have the same set of characteristics. Some have the innovation, but not the stability. Some have the stability, but are not maybe in a growing region. Some are innovative, but not in a growing region. So having the combination of these 3 major factors is something that we think is still very helpful to us.
So global talent is very important, right? Especially when you're looking at building up certain industries. But how do you balance the need for global talent with local concerns that, are our jobs going away to other people, and that pops up from time to time, every few years. So how do you straddle that?
I think that it's very, very important that for the EDB, good jobs for Singaporeans is actually one of the key indicators that we look at. Everything that we do to build this economy is to ensure that our people have access to jobs, and good jobs with leadership opportunities. So we've been doing a number of things in this regard. The jobs, definitely the numbers are there. We brought in roughly 17,000, 18,000 jobs last year. The good jobs metric is something that we are also strongly measuring. In other words, what are the salaries that these jobs can command, and are they above the natural median of the economy, were the economy not to have as much manufacturing and tradable services. And then to ensure that, Singaporeans are getting those good jobs. So what is the percentage of localization in many of these companies? More recently, we've been looking at corporate leadership and working at grooming Singaporeans for corporate leadership positions in multinational companies, regional leading companies, startups that are fast growing, and also even large local enterprises in Singapore. We think that after all these years of building up human capital in Singapore and making sure that we have a highly educated, very experienced workforce, it is time for our own local talent to be able to flex their wings and actually go out and get more exposure in order to be able to serve in some of these major leadership roles. So the suite of these activities is under the Singapore Leaders Program, SGLN, or the Singapore Leaders Network. And recently we've announced that we have, after 1 year, 1,000 members in this network. And it is run by the Human Capital Leadership Institute and currently provides great opportunities for mentorship between young Singaporeans who want to be corporate leaders and others who are Singaporean or not Singaporean who are willing to mentor them and to encourage them, particularly to take overseas postings, and especially overseas postings in emerging economies and more challenging markets in order to build up the P&L experience and the overall experience with the company that will be needed for them to say that they are qualified to move to the next stage, to be the ASEAN head, to be the APEC head of region, to be the global head of a particular product line. And so this is getting some good momentum. It's also tying in with the Forward SG exercise, which is also looking at how we can improve our level of corporate leadership among Singapore residents. So these are a range of things to ensure that really that the fruits of growth benefit the people of Singapore.
Is it difficult convincing Singaporeans to go out and take jobs in this sort of markets?
It's oddly enough been more difficult than anticipated. Singapore turns out to be we are getting a lot of feedback. This is all based on a large number of surveys and feedback that Singapore is a comfortable place. As much as it is a comfortable place for expats to come and live here, it is also actually a pretty comfortable place for Singaporeans to grow up, to live, to bring up their children, and even for their careers to prosper. But their careers will prosper up to a certain point. And we think that without overseas experience, many companies and many MNCs tell us there will be a ceiling to how far an employee can go if they don't go out and test the waters in another jurisdiction that company is selling to or that company is making the product in. So these are some of the elements that I think we're putting in place. It's very interesting because I know many countries struggle with brain drain and many of their best and brightest wanting to go out. And it's funny, but we seem to have the opposite problem. So many of our best and brightest like to stay here.
It's not a bad problem.
There's always a flip side.
Let's go back to semicon. Right? Singapore just opened the new Global Foundries plant, $4 billion. So how does Singapore compete with to attract this sort of investments when so many other places are handing out subsidies and large subsidies?
Yes. Industrial policy has become extremely popular and more prevalent in the last year than in many of the preceding decades. I think most large developed economies really eschewed industrial policy or any notion that they were picking winners in terms of their industries or in terms of sectors or even firms until more recently. And so there has been increasing competition for investments, and particularly those that are regarded to have strategic importance, and that includes certain types of semiconductors. Thankfully, and I think the Global Foundries example is a good one here. Singapore does not compete in advanced nodes and advanced logic. What we have is, wafer fabs that produced mature nodes. And those are actually not particularly affected either by various restrictions. But on the other hand, they actually turn out to be exactly the kind of chips that are highly in demand for smartphones, the chips that are highly in demand in cars. The vast majority of chips in a connected car are in mature nodes. They're actually not in advanced nodes. And even for a handphone 5G handset that has very advanced chips, they're surrounded by less advanced chips. So the bulk of sale actually is in the mature nodes. In addition, Singapore is also a semiconductor tool manufacturer. So we make 20% of the world's semiconductor tools, and also 11% of the world's chips. The increasing competition in terms of industrial policy or fabs or factories being set up in other parts of the world actually increases the demand for tools. So this is actually another source of potential demand for our industry.
Does it mean that when it comes to semicon industry in Singapore, that the US and China tensions and their cheap war doesn't really affect the
I think
industry?
in the near term, the thing that is really affecting growth and output in the semiconductor industry is the electronics downturn. The electronics downturn right now, which is actually a global demand downturn, it's actually a global downturn in the demand for maybe consumer goods or hardware in general, is actually the thing that is most pertinent for what's happening in the industry right now.
Okay. I'm going to give you one last question, and then we'll open it up to the floor. Yeah. So let's talk about EDB's interest in family offices. We do have, EDB does have an entire page on the website on family offices. How do you see family offices fitting into your vision of creating sustainable and economic growth in Singapore?
We currently have about, I think the last count was 1,100 family offices in Singapore. And we run the family office development team together with the Monetary Authority of Singapore, which also gives out and also regulates and licenses. It licenses multi-family offices, and it also, for single family offices, they have to come to the MAS if they need tax incentives. So 1,100 is the number of single-family offices. Now, the purpose of having family offices here is actually not for its own sake. And for the EDB, it's not about capital inflow. Capital inflow is just not a KPI for us. What is a KPI is what that money goes on to do. And there are three ways in which this is actually interesting. One is business interest. Family offices very often come with family businesses, particularly in Southeast Asia and other parts of Asia, including China and India. And increasingly, we are also seeing interest from Europe and the US. So the family businesses put very concrete operations on the ground here. They will set up HQs, they will hire people, they will build business out of Singapore. And if you've seen what's happened with Southeast Asian family offices, a lot of product is also developed out of Singapore. There's also investment interest. Family offices do and are required to put that money to use, so that they may be limited partners in VC funds, which then go on to invest in Southeast Asian startups. I have seen some family offices as very active direct investors in Southeast Asian startups and Singapore startups. I've seen a variety of activities where family offices actually work directly with a company to actually provide their networks to help that grow and to connect it with the family business and avail the distribution channels or the production network of the family business. The last kind of interest that we have is to ensure the money goes to work for impact giving or impact philanthropy. A lot of family offices come here saying that they want to create foundations and they want to give to various causes. This is very helpful to us because, in some sense, it provides, it plugs a gap in the system where philanthropy is most useful. So a lot of the causes that we see philanthropy being deployed in include education and education-related causes, but increasingly climate philanthropy, or giving towards either technologies or solutions that help with sustainability. So these are some of the major trends that we see for family office in terms of philanthropy, for investments, and also for the linkage to business interests. So this is the reason why we want family offices here. They have to do something. In that light, we've worked with the Wealth Management Institute and the MAS to start a brand new course for family offices, so that all family offices have to attend this a new sort of training to better understand how they can deploy their capital, where they can deploy their capital, how they might want to think about succession planning or family governance, and how they want to think about foundations and philanthropy, and also where they can deploy their money in terms of impact giving. So this has not existed in the past, but I think that it will make a big difference with all the family offices that are coming in.
Is it a compulsory course?
I can't remember. I'm sure we would want to make it a compulsory course if there are tax incentives involved.
Do we have any questions?
Jacqueline, thank you for your insights. You've talked about the strength of the Singapore system, and thanks for your contribution and the entire, to see how strong the economy has been over the last few years. But maybe talk a bit about the weakness, the Achilles heel internally. Where do you see it? And also externally, where are the threats, whether it's from other financial centers or geopolitical threats to kind of derail the entire competitiveness of Singapore?
Yeah, I think that basically some of these trends that are facing the rest of the world, we are not going to be immune from. Two major ones that are external that we are watching with more concern and also preparing our strategies to deal with them. One is geopolitical. So obviously this movement towards deglobalization or the decoupling of economies or the prevention of either exports from reaching another location or technologies from reaching another country will, I think, result in an outcome that is for the world something that might cost more, something that for taxpayers might cost more, and also it stymies the kind of innovation that you would otherwise get in a far more liberal free trading system. Singapore is a very trade-reliant country. We believe in a sort of global rules-based order, and we would like to see that continue for as far as possible. So we believe that to the greatest extent possible, we should enable those corridors to persist. If there are any restrictions, that they should be as narrow as possible in order to create the biggest welfare outcome for everyone. And that's not just for one country. I mean, without a much freer flow of technology, some small countries are never going to get the benefit of innovation. Without the ability to sell to big countries, other countries are never going to be able to lift their development status and possibly lift their population out of poverty. Singapore has been a big beneficiary from a system that has allowed us to do both in previous years. And so we think that this is something that we will have to cope with. Certainly, we have also done what we can to build our own regional strengths, our own regional supply chains. We're increasing the efforts on our regional supply chains and in cooperation with Malaysia and Indonesia, particularly in SEJORI, we call Singapore, Johor, and the Ria Islands, to enhance the investment into all of these territories so that together as Southeast Asia, we can be a far stronger proposition as a production base, and particularly as a production base with shifting supply chains. With shifting global supply chains, we can still be incredibly competitive as a production base. And over time, Southeast Asia is also becoming a stronger source of final demand. So for both of these things, thankfully, these trends are in our favor, but it's still not in general good for the world, for deglobalization to continue at a very fast pace. The other big threat, I think, is climate change. And I think you'll hear this in many contexts. Singapore is not going to be immune to climate change. Like many countries, we have a large amount of this country that is not more than 5 meters above sea level. And as a result, a lot of investment has gone into providing stormwater detention tanks to alleviate flooding, to improve coastal resilience with the use of polders, so that we can keep the sea level rise from actually affecting our businesses and our dwelling places, and that we won't get flooded. So, basically, rain may be inevitable, but floods are not. So a lot of effort is being put into these pieces, but it really does take a lot of effort, and there will still be impacts in other ways. For example, even if Singapore does a lot to invest in climate resilience and climate adaptation, as long as any other country that we are importing our food from, or getting our water from, or reliant on energy from, or reliant on imports from, or other kinds of manufacturing imports from, is affected by any of the results of rising sea levels, wind, heat, floods, it's still going to affect us, and it's going to affect our economy in a significant way. It's going to be a very expensive endeavor. And so we've done quite a bit to advance our own net zero by 2050 plans. So in terms of climate mitigation, we're going to do our part. In terms of climate resilience, we are going to put in place our own measures. But we also have to think about what it means to diversify and monitor and make sure that we can also put in investments in climate tech to help other countries cope with the same effects on their agriculture, on their aquaculture, and on cooling their environment, because this is something that Singapore does know a little bit about. So there's countries that have never had 50-degree heat, 40-degree heat, humidity, or mosquitoes. Apparently, Bavaria is now has more tropical mosquitoes in summer than they've ever thought they would have. So I think these are some of the things that Singapore may be able to develop, the kinds of technologies to be able to share with the world.
I think we have time for another question.
Thank you. Tatiana Collins here. Jacqueline, thank you very much. Enjoyed listening to you. Undoubtedly, Southeastern Asian countries within ASEAN look to Singapore for the blueprint for innovation and have replicated that. Where would be your number one area where you would love to see more of that collaboration and also that adoption of some of the Singapore practices?
I don't think there's Singapore practices per se. I think there's a lot of room for collaboration within ASEAN, though. I mean, and particularly within Southeast Asia. I just list two areas where actually some developments have taken place of late that are very encouraging. And they respond to some of the biggest concerns that have been raised in and of Southeast Asian countries. One is energy, and the other one is digital and data. So I think from our digital economy colleagues, we do constantly hear that ASEAN is 10 countries, but ASEAN is not one country, it is 10 countries. And data regulations and digital standards across these countries can vary. And that makes it sometimes a bit difficult for digital economy and tech companies to really exploit ASEAN as a full market. So very recently, I think you will have noticed there was an announcement of an ASEAN Digital Economy Framework Agreement. And so negotiations have started on this, and it includes all of these pain points that have been raised over the various years. So we hope for the best. It's a big movement. It's a big improvement. And I think that it will bring about a lot more harmonization of standards within ASEAN for digital and data. So that's one big piece. The other one is called the ASEAN Power Grid. So some of you may have heard of this. It's the effort to bring green power through the whole of ASEAN with a more linked up power grid system. So Singapore contributed to the first leg of the ASEAN Power Grid with Laos recently when we bought hydropower from Laos. But it was just a test. I think it was about 100 megawatts of green energy. And then that was the first leg of the ASEAN Power Grid. But we've also publicly discussed some MOUs and agreements and concrete agreements with Cambodia. More recently, there's been a conditional approval to 5 companies for Indonesia for renewable power, most likely solar. So it's that really great combination of the fact that we have a lot of renewable resource in Southeast Asia, hydropower, geothermal, solar, wind. Actually, all of these resources do exist. And if we put all of these together and we find good ways of developing renewable energy projects and linking this together in an ASEAN power grid, it's a win-win for all the parties involved.
One last question.
Thank you very much. I just had a question on the rise of certain financial centers like Dubai, which have come up very rapidly in recent times. And there's a lot of momentum going with the Middle East right now, and with influx of people coming from all over East, West into places like that. Just wanted a view on that and whether Singapore is even looking at what's going on in Dubai.
Oh, I think we collaborate and speak to our friends in the UAE quite often. I've actually made 2 trips there in the last, I think, 8 months. And actually, we're doing quite a bit in terms of collaboration. Even the Global Foundries factory opening that she just mentioned, the chairman of Global Foundries came to open the plant, and he is from Mubadala in the UAE. So there are a number of exchanges that are quite strong. Singapore remains a tier 1 financial center. So, and it is in Asia. So in that sense, I think our role and our purpose and our catchment is somewhat different from the Middle East and Africa. It's not a MENA catchment. So we can afford to have very good relations with Dubai. We are, also, keenly observing developments there in terms of the green economy. And how the Middle East is taking its own fossil fuel advantages and putting that into investments into green energy. And so we're looking at that, particularly in hydrogen, with some interest.
Okay, I think we have run out of time. Thank you so much for joining us today, Jackie. And thanks everyone for being here.
Thank you.
Thank you, Jacqueline and Xinwei, for another great discussion. Being in a location where your best and brightest don't want to leave seemed on balance like a fairly good problem to have. That brings today's event here to a close. Thank you to all our wonderful speakers, our interviewers, and our host, LSEG. And finally, thank you for all attending, either here in the room or virtually. Do look out for more Reuters Newsmakers coming over the next few months around the world and here in Asia. And so with that, thank you. And for those in the room, please do join us for drinks. Thank you.